Hello,
Hello,
everyone.
everybody. Hi, Socrates.
How's it going, Tyler? It's great to see you.
Yeah, really good. Formal introduction to the new senior analyst at Lucid Investment Strategies. Everybody knows that Socrates has been an invaluable help to us all the way back to Las Vegas, and before that was doing a lot of stuff in Telegram. But he's been contributing so much, a lot of stuff people don't see behind the scenes, and more and more of that'll start coming out, including the book that he's put together. And I've looked over his shoulder, but I haven't had to make very many corrections because he takes such great notes about everything that he got everything right. But as you all know, now the important thing is him helping with not only the analytics, but trading strategies, new trading strategies that I haven't really used. He's picked up a number of strategies that I've used for years. And the great meld here, from my point of view, is having somebody as capable as Socrates doing short and intermediate term work that so many people are really interested in, particularly in the crypto world, but more and more a number of our clients on traditional markets, that it just works terrifically well with my long-term approach in terms of a bridge between today and years from now in terms of various strategies. So it's been a lot of fun for me. And today we're going to try to get closer to the answer about how in the world, particularly on TradingView, are these SARs being calculated. And Socrates has spent a lot of time trying to hand calculate, and we just can't seem to find the answer. But we want to walk everybody through what the problem is, and hopefully someone out there, what we're really trying to do is just find, what did Wells Wilder Jr. originally do? I've got the answer to that in a box somewhere, in storage somewhere. And, sometime over the next 2 or 3 years, I'm sure I'll be able to find it. But in the meantime, there's something rotten in the state of Denmark with the way the SARs are moving around midstream on TradingView, which did not happen with the original calculations because I used to do all of them by hand. So there's something missing, and hopefully somebody can help us, but we're going to walk you all through that. And then we hit new highs today. Markets closed early, but we do want to talk about the S&P 500. And Bitcoin made a very nice move to the upside, and then it looks like it stalled out again around that 11.5 area, but we'll take a look at that. Socrates, how you doing?
Hello, I am doing excellent and very excited to have been coming on board full-time with Lucid. I couldn't be happier about the opportunity, and getting the chance to learn under someone such as yourself is a tremendous opportunity that I will certainly hope to take full advantage of. So really appreciate you having me on today. Very excited to take a look at some charts, and also hope to figure out this Parabolic Sar calculation. We're not really today going to be going over how it's used. There's plenty of videos and articles out there telling you what to do when a SAR breaks, and potentially how to use it to trail stop losses and determine trend. That's not what we're going to be talking about today. We're actually going to be looking at how is it calculated. And so that's going to be our focus, and we'll be excited to hopefully try to start to demystify that. As Tyler said, we have come to a bit of a roadblock that we're hoping somebody out there listening today will be able to help us, because right now we are kind of scratching our heads as to how it is being calculated by TradingView. So with that being said, should we go ahead and jump on in and take a look at some calculations?
Yeah, that's terrific. Let's do that.
All right, I'll go ahead and share my screen. And remember to click on that. Okay, so here is the best, most reliable calculation that I could find. I searched high and low for on Google for Wells-Wilder original parabolic SAR calculation, and I couldn't find anywhere that said clearly in writing, this is how Wells-Wilder originally calculated the parabolic SAR. A lot of websites reference him as creating it, but none say specifically that this is absolutely the original formula that hopefully Tyler will be able to uncover in one of his old storage units or wherever that box may be laying. But this is the calculation that I am most comfortable with, assuming that it was how Wells-Wilder calculated it. And maybe that's correct, maybe it's not, but this is the best that I could find. This is coming from Corporate Finance Institute, and all they do is reference Wells-Wilder, and they don't make any mention to making any changes or anything like most do. So this is the calculation that we are using right here. The calculation is different for an uptrend parabolic SAR than it is for a downtrend parabolic SAR, but the variables are all essentially the same. What you need is the prior SAR, the prior AF, which is the acceleration factor, and this can be kind of confusing. So the acceleration factor is initially set to a value of 0.02. It is increased by 0.02 each time the EP is recorded, with a maximum of 0.2. EP is the extreme point in a trend. Extreme point meaning highest high in an uptrend or lowest low in a downtrend. And I understand this to be the peak, the wick, opposed to the close. It's the highest point reached by the price during an uptrend, not necessarily the highest close during an uptrend. So essentially, you start with an AF that is set to 0.02. Each time an extreme point is reached, if you're in an uptrend, a highest high, each time you get a new highest high, then this is increased by 0.02. If you get up to 0.2, then you have maxed out the acceleration factor, and it can increase no more regardless of further higher highs. This can be adjusted. The acceleration factor can be adjusted, but this is the traditional acceleration factor that Wells-Wilder used. This part I have seen time and time again as 0.02, increased by 0.02, maxing out at 0.2. So here is our calculation for an uptrend parabolic SAR. We have prior SAR plus prior acceleration factor times, and in parentheses, we have prior extreme point minus prior SAR, close parentheses. And for downtrend parabolic SAR, we have prior SAR minus prior acceleration factor times, and in parentheses, prior SAR minus prior extreme point. So
I just realized something on that I didn't see the first time. which is that in the parentheses in an uptrend, it's the prior EP or extreme point minus the SAR, prior SAR. And in a downtrend, it reverses. It's the
Yep,
prior
and that is
SAR
important
minus
because
the prior EP.
yep, that's important because if it wasn't reversed, you would essentially get a negative number, which wouldn't make sense. So it's using the same variables, but it's just making it such that you'll get a positive integer. And I have calculated it wrong and basically realized that I used the wrong one here, and it gave you a negative number, and
Gotcha. Okay, good. That
makes
makes
it erroneous.
sense. Right.
So the question is, what can cause a SAR to change while the candle is still open, while the candle is developing? A new SAR will print as soon as a candle opens. And then sometimes that SAR will adjust while that candle is still open. And the question is, what could cause that to happen? And the only factor in this formula that could cause a SAR to adjust while the candle is still open is if you get a new extreme point. That's the only thing in this formula that could affect the calculation in real time. Everything else is all completed. Whereas if you do develop a new extreme point while the candle is still open, then that would affect this calculation. So that makes sense to us, that the SAR could be adjusted in real time if a new extreme point is created. In the sense that if you have a downtrend parabolic SAR, if you create a new local low, now you have a new extreme point, which affects this, and it affects your acceleration factor. So you're going to have a new calculation. If you're in an uptrend parabolic SAR and you create a new high, a new local high, then you've got a new acceleration factor and a new extreme point. Calculation changes. However, we have seen an example where the SAR adjusts in real time without a new extreme point being created. And that has us both really scratching our head and wondering, how could it possibly be? And the only real solution that we can come to is that TradingView is using a different formula to calculate the parabolic SAR. That's the only thing that we can come to because there's nothing else that would cause that to happen in real time. So I want to thank Ben Peterson for sharing these charts in our Telegram group. He brought this to my attention. I did not think that this was possible, what we're looking at right here. And he's showing that indeed, not only is it possible, but here it is, it happened. So I'm looking at this and really scratching my head and trying to understand how this could be. And that's where we have come to a dead end. And we're hoping our intelligent and loyal followers can give us a solution. So let's take a look here. We're looking at the same chart. They're both Bitstamp BTC USD weekly charts. And it's the same week, July, the first week of July. Okay, first week of July right here. First week of July right here. Green for this candle. It's the same candle on the same time frame, on the same exchange of the same asset. And the parabolic SAR was at 9952 right here. And then we see somehow it is adjusted down to 9,608. So that is almost a $350 change in this SAR that adjusted down in real time while this candle is open. So that if you used this SAR as your stop loss at 9952, you would have expected it to get triggered, but then all of a sudden this SAR had moved down and away from the price. while we had not created a new extreme point. The only way this SAR should be able to adjust is if a new extreme point was created. On this chart, we have an uptrend parabolic SAR, and the extreme point is on the 3. The highest high in this uptrend is very clearly on the candle before. Therefore, this SAR should not adjust at all. There should be no variable in the formula that changes in real time. So that is what is really bothering us. And we're going to go through a quick calculation to see how we understand it and try to just basically uncover our understanding of where it should be and where it actually is showing up on TradingView. So this SAR moved almost $350 in real time without a new extreme point being created. So that just does not make any sense to either of us. That is where we really have been scratching our heads trying to figure this thing out before really doing this podcast to try to explain what we don't quite understand yet. So we decided to go with our best understanding and hope that somebody out there knows a little bit better than us. So what we're going to do is calculate this SAR in real time and see where we think it should be compared to where it's showing up on TradingView. Okay. So let me get some of this junk out of here. All right. Okay. So let's go through this calculation together to calculate the SAR, the weekly SAR for the week of July 1st, 2019 on Bitstamp. Okay, so we have Uptrend Parabolic Sar. So this is the formula that we are going to be using. First thing we need to know is prior SAR. Okay, so the prior SAR is 9,364.01. All right, so we're going to go ahead, 9,364.01. That is the prior SAR. Okay, and now we will do plus the prior AF, which is the acceleration factor. And that's where it gets a little tricky, but we can go ahead and go right through that. So it starts at 0.02. Let's confirm with TradingView that they're using start 0.02, increment 0.02, max value 0.2. Okay, it's using the same thing that we think it should be. So the uptrend parabolic SAR started right here. Okay, that's when we broke the downtrend parabolic SAR and became an uptrend parabolic SAR. So right here, the acceleration factor is 0.02. We get a new local high, so we increase it by 0.02. So now it is 0.04. New local high, 0.06. New local high, 0.08. No new local high, still 0.08. New local high, 0.1. New local high, 0.12. New local high, 0.14. New local high, 0.16. New local high, 0.18. New local high, 0.2. And that's the maximum. So right here, we maxed out the acceleration factor, and it is 0.02. Excuse me, 0.2. Maxed out. That is the acceleration factor. Now, in parentheses, we have prior extreme point. Extreme point is the highest point reached by the price during an uptrend. What is that? We've got the high is 13,880. 13,880 is the prior extreme point. And then we do minus the prior SAR, which we already have right here, so we don't need to go refigure that out. 9364.01. Okay, so we've got our formula. We've got prior SAR, 9364.01. We're just going to make sure everything is right. 9364.01, that's correct. Our acceleration factor plus acceleration factor, we don't need to go through that again. It's clearly been maxed out, 0.2. Times prior extreme point, which is 13,880, which occurred on the week of June 24th. And minus prior SAR, which is again 9,364 and 1 penny. Okay, and now we start with the parentheses, and oh geez, I don't know what happened there. Oh, you didn't do that to me, did you? Unbelievable. I can't believe it. Oh, no, it didn't do it to me. Sweet. All right. So what we're going to do is a new text box down here. And we're going to start with the parentheses. So we do 13,880 minus 9,364.01. That gives us 4,515.99. Okay, so that is right there. Now we multiply that by 0.2 before adding. So 4,515.99 times 0.2 gives us 903.198. And now that gets added to the prior SAR. That's where we, excuse me, that uptrend prior SAR, yes, that gets added because we're needing these to increase and continue moving up. So 903.198 plus the prior SAR, which is 9364.01, equals 10,267.20. Okay, so that is our calculation for the weekly parabolic SAR, is that it should be at 10,267.2, and that is right about here. And when that broke, when the wick crossed that area, 10,267.2, without establishing a new extreme point, that should have broken the SAR, and that should have established new downtrend parabolic SARs, which would have put in a new SAR at the prior extreme point above the candle that broke it. So when we wicked just for even a second for one trade below 10,267.2, the uptrend parabolic SAR should have broken and should have printed a new downtrend parabolic SAR at 13,880 above the current candle. That didn't happen. Instead, this SAR moved down a huge way. Now it moved down over $600 from where we have it originally calculated. And there is nothing in this candle that should have affected our calculation. Therefore, we believe the SAR should right now be at 13,880 because it should have been broken when the price wicked below 10,267. And when you wick below, when you break a SAR, a new one immediately gets printed in the opposite direction. You don't have to wait for a close. Basically right here, when this thing wicked above the uptrend SAR that was above it, as soon as it wicked above, it printed a new SAR below this candle at the extreme point, at the lowest low of this move. It didn't wait for a close. As soon as it that's what it should have done. I don't know what it really did in hindsight, but that is how we understand Wells Wilder's original calculation, that as soon as it gets broken for even a second, then a new one prints in the opposite direction. So that is my calculation for the weekly Parabolic Sar on Bitstamp for this week, the week of July 1st, 2019. Yet we see that it is being calculated at 9,614 by TradingView, which is way off. And the fact that it's been moving down is very much against how we understand this indicator. So that does it for me. What are you thinking, Tyler? Anything coming to your mind?
That's a great job. I know it gets a little tedious looking at details like that, but this is such an effective technical tool, and has been not only for Bitcoin on the upside, on the downside, but almost every single asset class I've ever studied. One of the problems with relying on charting platforms is you simply assume that what you're looking at is correct. And we're not saying that TradingView's calculations are incorrect. We're just trying to find out what they are, because we don't see anywhere where they tell you how they do that calculation. So Socrates and I spent a lot of time looking at a number of other sites that use this, everything including stock charts and Ninja and a number of other ones. And it's very difficult to get how they are calculating it. So then you assume it must be the way Wells Wilder did it back in the 1970s. And I'm embarrassed to say that I went years and years doing the calculation myself until these computer programs came out and did them for us. And then I spent years and years and even decades not doing the calculations anymore. And so it's difficult for me to recall. Now, things like the sequential trading system, I've still got all the original paperwork, and many of the other systems that I've learned, I've got the paperwork showing all the calculations, how you do everything you do. I just haven't been able to find my original Wells Wilder stuff. So it's an open question. I'm not saying one is better than the other, but this clearly isn't what that formula that Socrates just used. That's not how this is being calculated. So anyone that can offer any sort of help in clearing this up, I think it will be valuable to the entire community. So thank you very much, Socrates, for taking the time to do that and showing everybody exactly why we're scratching our heads a little bit here. And in this particular case, how important it is. Because in this particular case, we're saying that the uptrend in Bitcoin on Bitstamp came to an end this week. And here we're looking at a chart saying it is still in the uptrend. So we need to get that resolved. And that's one reason you don't use one indicator. You use multiple indicators that confirm or deny what other indicators are telling you, so you can use your own thinking and your own experience to draw your conclusions. Okay, so why don't we now move on to the stock market and take a look at something that's pretty exciting. And we will be using TradingView again. So remember that we're looking at SARs. We've got a question mark. But we've got many other tools. Socrates has introduced me to ones that he's gotten very proficient at. So why don't we do that, unless Socrates has a final word on the stop and reverse calculation?
Yeah, just a final word that I think it is very important to go through these calculations and really make sure that you do understand the indicators that you're using inside and out. for me, going through the calculations for the TD sequential and actually figuring out those numbers by hand, that's when I really started to really understand how it was working. And then I could start to visualize it without even really needing to have the indicator on the chart. So I am a big proponent of going through the tedious steps of actually hand by hand calculating every indicator that you use, even something like a moving average. It seems very basic and simple, but I went through and calculated long-term and short-term moving averages by hand and was blown away by how much or how little they would be affected by a big move coming on or a big move falling off, and then seeing just a small tick in a long-term moving average now means a lot more to me that I have actually gone through and done those calculations. So I would definitely recommend that, and just also want to point out how important it is to clarify, the indicators that you're using. I'm so glad that we have gone through this. I thought I understood the Parabolic Sar until Ben Peterson showed me how it can change in real time. Now I'm really scratching my head, and I'm looking at the chart like in a different way, in the sense that I'm breaking down the low of this candle that confirmed the shooting star and was very important to me. And then that also is right where the Parabolic Sar broke as I have it calculated. So seeing a weekly SAR break when a high volume shooting star confirms, that's hugely important to me, but I would have never been maybe aware that that's possible if I didn't know what was going on here, if I wasn't calculating them by hand. So again, just wanted to say thanks for everybody for looking into this, and any information that you can provide will be very much appreciated. And I will go ahead and pull up the stock market. I don't have a whole lot to say. If you want my analysis on this chart, go listen to yesterday's vlog. I talked about why this looks so bullish to me, and I talked about why I bought minutes before the close, minutes before going live. No sense in really repeating everything. We've got this cup and handle that looked like it confirmed here, kind of had a bit of a pullback, but that formed a higher low, gave us a Bill Williams fractal, and then we got what looked like a breakaway gap here. This red candle was still a little iffy, but once we got this green one that closed above the prior open and created a higher low, leaving us that breakaway gap intact, I had everything that I wanted to see to go ahead and enter. I don't love buying breakouts, and that's generally because they don't provide the greatest risk reward, and I'm all about the risk reward. So the breakouts tend to have a lot more risk than I like taking. I generally like about 5% or less risk on the positions that I take, and breakout trades generally, in my experience, come with significantly more risk than that. That's the main reason why I don't like to take them. If I do see a breakout that is providing a good risk reward, that's kind of like the best of both worlds, because I do want to buy strength and wait for a trend to prove itself, in as much that I can also manage risk. So if I can get a good risk reward on a breakout trade, that's the best of both worlds as far as I am concerned. And that's what I was seeing right here. Because we had this breakaway gap, we had this nice kind of wick, we had this higher low, and we had the close above the prior open, and we had the Bill Williams fractal that was established on the prior pullback. I love using daily Williams fractals as stop losses for swing trades and sometimes even position trades. And that gave a very desirable risk-reward ratio. Essentially, I was looking at price range. So I was looking at entering on this close here. setting my stop loss slightly below the prior daily Williams fractal. That provided a 2% risk, which is right in my wheelhouse, right in my sweet spot. The reward based on the measured move from the cup and handle is approximately 20%. Yep, 20% almost exactly. So that gives me a 10-to-1 risk reward ratio, which is basically as good as it ever gets. I got that risk reward ratio on a breakout trade. So that's kind of like having my cake and eating it too. And it's easy to say all this after we have this nice big continuation candle that has taken us from a low of 29.78 up to a high of 29.95, which is where it closed. That sure makes it easy to say how nice of an entry this was, but that's not how I look at things. I'm never results oriented. If I have a big loser or a big winner, I'm looking at the process, and I'm not focusing on things that are out of my control. This is out of my control, this candle here. This candle could have easily been in the other direction and come all the way down here and knocked me out. The day after I opened the trade, I easily could have been stopped out. Would that have changed my mind on this being a great opportunity to enter? No, not at all. And that's very important to understand, that you just can't be results oriented. If you find a great setup and it costs you money, and it does that 3 times in a row, you still got to be able to pull the trigger on that 4th time. You can't be so results oriented that you're going to change your trading style because you have a couple ones that go bad. So even if this candle was really ugly that brought the price back below 29.50 or so, I'd still be very thrilled with that entry. Getting a 10-to-1 risk reward ratio on a breakout entry, that's very tasty. So I'm very happy and liking this candle very, very much. This is huge to me. This is confirming that the breakout is real. And now that we're getting up towards the 3,000 area, things are getting very interesting. If we can break through that, then it should be all things are a go at that point, as far as I'm concerned. So do you want to pull up your own chart, Tyler, or do you want to just
I
add
think that's great. As people know, on the chart we're looking at now, the S&P, this is a very unusual chart to drop all the way from 2,950 or so all the way down to 2,300 and then go straight up again. Yeah, you see V bottoms every once in a while, but this was such a remarkable one because it's in the largest stock market in the world, in the largest economy in the world. And what that pattern is saying is nobody knew what was going on. No analyst, no investor, no central bank, nobody had a clue. You can't drop straight down in a strong economy and then go straight back up, basically 20% from top to bottom, and then the big surge right back up. That means no one had a clue. There was no good information. And then we had a little mini one right after that. So we were basically out in the down portion of that and completely out in the last half of that down portion from the 2,900 down to the 2,350. But then we were late getting in because we were sitting in cash. And luckily, it was the end of the year, so I did put 50% in, thinking there would be a year-end market rally, but I didn't expect it to go beyond about late January or February. But it kept going, and it kept going, and all of a sudden, we only had 50% in, and this thing looked for real. And it took me all the way to the beginning of April to say, this thing is for real, and to go 100% in the market. Then after we were 100% in the market, we got another little V, and I ended up incrementally, because of Consensio, taking out 5%, 5%, 5%, 25%, up to 50%. until we stopped going down and came back up again. And then I put that 50% back to work after those 4 green big candles off the bottom. When we finally cleared that area of congestion coming down, which lasted 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days basically, including that big gap down red candle that was very scary. That one on the right, and there's one on the left that just came out of nowhere. It really looked scary. Well, we got through both of those with the 4 big green candles going up. And at that point, we got fully invested again as we neared the top and have been there ever since. Now, my targets are up around 33 to 3,400. Socrates showed a calculation yesterday using this funky cup and handle, and that's up around 35 or 35.50. Whatever it is, those are big numbers in the largest stock market in the world. You're basically talking about a move from the 2,900 to 3,000 area all the way up to, let's call it 3,500. That's 500 on 3,000. That's 1.6. That's about 18% in this huge market. And we're already halfway through the year, and we're saying after a big move already this year, remember we started this move at the beginning of the year all the way down at 2,400. That means if you were in this entire up move from January 1st of this year, not only do you have close to a 20% return already, but you may very well have another 20% on top of it, which would make it one of the biggest moves for the S&P in the history of the market. So there's a lot of reason to be sort of excited, and not just about making money in the stock market. What does that mean for the health of our economy? What then does it mean for the health of the rest of the world that trades with this economy? It's a very bullish thing that people need to focus on. It's not just another asset class. So as you can tell, I'm very excited about this action, and I love the way it's working out technically. That doesn't mean it's going to happen, but it means that we will be talking more and more about it and make sure that this thing is as good as it really looks. If it is not, if it peters out like it has done before, we'll be on top of it. Okay, yeah, that's all I really needed to say there. Why don't we jump into the Bitcoin world again, because it surprised me last night. This run from 10,000, below 10,000, all the way up to 11.5, after a lot of things looked like they broke down, and all of a sudden the stop and reverse that we just looked at looks prescient because it said it wasn't broken and we're still in an uptrend. So I'd love to see what Socrates has to say about that. Do you have any other comments on stocks first?
Yeah, I am very excited to look at Bitcoin, but there is a bit of a side road that I want to go down because it interests me greatly, and I think you as well. And that to me is, looking at this chart, there are a couple things that you said that really kind of jumped out at me that I really agree with, and that this is just not natural. Like, this is not, to me, an organic chart. This big V bottom is something that is very rare in markets other than the S&P 500. This is the same thing that we essentially got down at the bottom in, it's much different down here at the bottom of 09 because what preceded it, but it's still essentially, you get the same V sort of formation. Find me another chart with 2 of those V's in the last 10 years. I'm not saying it's not out there. I am saying that I haven't seen it, and I would love to, because I think it's a lot more rare than we see in the S&P 500, where it seems like we kind of get it over and over and over and over again, where it may not be this exact V, but it's still kind of the same sort of formation where you have this huge spike down and then a rebound without any higher low, really. We just this one kind of has a higher low, so it's not quite as much as these others. But we just see this in this chart over and over and over again, this V action. And I know this is probably one of Tone Vays's least favorite explanations, but it's the one that I am thoroughly convinced of, and that is the plunge protection team. I think that it's pretty much undisputed that they are out there. I think Tone just disputes how much they are actually responsible for this major run-up. But it's like public knowledge that there is a plunge protection team. They're not elected representatives. They're basically a private enterprise. I mean, it's a very shady operation that I have very, very little trust for, that I think is highly responsible for these unnatural patterns that keep showing up. When you have a plunge protection team, that means you have unlimited money to prop up this thing right here. And what would it look like if you were pulling the trigger on protecting a plunge? To me, what it would look like is a V bottom or a V continuation, where this isn't really a bottom because it's after a huge up run. But what are the chances that this is the plunge protection team buying huge right in here? In my mind, the chances are overwhelming. And I'm interested to hear what Tyler thinks. But really, it's this pattern specifically that really jumps out at me and makes the hair on the back of my neck stand up and say that what happened here? Is this enough of a plunge for them to come in and buy heavy? And if so, is this what it would probably look like if they did? Did it try to correct even again here? And they just said, nope, not on our watch. We're coming in yet again to protect a dip, essentially. So just over and over again, we get these steep corrections that seem like they are wanting to continue further, but instead you get this very unnatural V-shaped bottom that is so rare in any chart other than this one and maybe some other large indices. So this is something that really kind of bothers me and makes me feel like this is not natural or organic buying action that has led to this, which has tremendous implications in the long run. I know that Tone Vays would firmly disagree with me. What are your thoughts here, Tyler?
Well, as you know, Tone and I are at odds about the definition of manipulation and how it can affect the market. And there are a lot of nuances. Usually the term manipulation really meant all the kind of ugly things that go on with and have for the last 100 years in publicly traded markets with insiders versus outsiders. When it starts getting linked to governments, we already know a number of governments around the world that do it, say they do it, everybody knows they do it, and you've just got to be on the right side of what they're doing. Particularly in Asia, Japan comes right out and says it. Their biggest pension fund, which is really almost like a sovereign wealth fund, is used consistently to buy shares in other companies in order to keep prices going on, particularly after so many years of their prices dropping. And now they're not embarrassed to come out and say, here's what we do and why we do it. The U.S. has never done that. There's no one that can be identified that does those kind of things. But very interesting for me to have followed the Federal Reserve taking more and more latitude in the markets. First of all, only with Fed funds, then with various types of treasury bonds and mortgages and Ginnie Maes and Fannie Maes and other things, and then coming right out and saying, not in a public statement with trumpets blaring, but sort of person by person, people on the FOMC committee talking about the actions we're taking. We're watching the stock market, that it's important for the stock market to go up. And anyone following this, not even very closely, but even casually, knows that this particular V bottom occurred precisely at the time when Chairman Powell of the Federal Reserve went against everything he'd been talking about up to that point about continually raising interest rates a number of times, not only in 2019, but until the job is done, until he finally said, nope, we've just been kidding, because we had just dropped 20% in the market down to that trend line. And it was precisely at that point where he came out and said, April Fool, everything we've just said for the last 2 years was just a poorly told joke, and there will be no increases in 2019. He didn't say it quite that way, but everybody listening knew exactly what he meant, and that's where the V took place. Now, getting any more detailed into that kind of analysis, we won't do publicly, but we'll be more than happy to do it in a webinar at a future time. I've been studying this since 1987, very, very closely, and would be glad to share my opinions in a smaller venue. And with that said, let's go to Bitcoin.
All right. Yeah, I'll be very excited to talk about that more with you. This is a fascinating topic for me. And yeah, before hopping into Bitcoin, just one last thing to show is something like this, to me, is very natural. Seeing this sort of W double bottom on a trend line, that is natural action to me. These V's, that's a very different story. And really what's happening is that you're smashing through bearish moving averages without really giving them time to cross, which is what happens in every other sort of environment. On this, it's like right here, you would come up and test the moving averages. They would act as resistance. You find support. You start to flatten out those moving averages. They start to come together, and now you break above. Now that's very natural, opposed to just spiking way down and then spiking back above them. That doesn't really make sense. So taking a look at the price of Bitcoin. I'm going to go ahead and turn off the Parabolic Sar and zoom in a little bit. I'm surprised to see that it's over 11,400. That is very interesting. So let's take a look. The 4 hour is the most important to me right now. And yesterday I was watching, I think it was either this candle or this candle as it was turning around. I think it was this candle. It looked like it got very close to my target of the 50 EMA, and then it was turning down, and I was not the happiest of campers because I had an order set to sell right at 11,000, and it looked like we were turning around before hitting my target area to sell. And then it responded, and in this right here, I got filled on my sell. So I ended up selling significantly more spot than I had originally intended, and that was basically a backwards way of kind of shorting, in the sense that my goal is to end up with more Bitcoin by buying back cheaper. But if I am wrong and I kind of have to take a stop loss, then I will still have the same US dollar amount of Bitcoin So I would only have lost on opportunity. That's the way to try to capitalize on the counter trend corrections in bull markets for Bitcoin, as far as I'm concerned, opposed to opening like a leveraged short, which I will do very, very rarely and selectively when I think that the time is right. And right in here is where the time is very, very interesting for that for me, because I really think that it's a high probability return to the 200 EMA. That's how I'm viewing this chart. Excuse me while I wet my whistle. So I said I was surprised to see it over 11.4. I'm really expecting this to come down soon because if this 9 EMA gets the chance to diverge from the 50 EMA and act as support, then it could break us right through this area of resistance. And if that happens, it's anybody's guess. As long as we are below 11,460, I am thinking that it is a high probability return to about 9,800 or so, wherever the 200 EMA is waiting at that time. And because of that, that's where I start to, this is basically, if I'm looking to short Bitcoin in a bull market, I want to make sure that I'm not doing that with more than about 5% of my entries. If 95% of my trades are long, and then in the most in the best setups or the most ideal circumstances, I am going for a counter trend move, then that is an okay ratio for me to make sure that I am trading with the trend the large majority of the time. But when I get a situation like this where I would be very confident in setting a stop loss above about 11,590, maybe even 11,540. That's an area where I'm very comfortable with the stop loss. If the price gets up there at any point, then continuation is most likely, as far as I'm concerned. And if this resistance holds, then we should correct here very soon, like in the next day. So in a position where I have a high confidence stop loss and a high confidence target that gives me a really favorable risk reward. Let's just go ahead and look at what that would be very quickly. Risk is going to be about 1.9% and reward. No, that's not the reward. This guy would be 13.66%. So again, we're somewhere in the neighborhood of a 10-to-1 risk reward. For me, that's what matters, risk reward. If I can realistically expect that profit target to be hit, and I have a sound stop loss in place, then I am interested in trading against the trend, because I only need to be right a very small amount of the time to consistently be profitable. And to make sure that I'm not going overboard with these types of situations, I am kind of monitoring how often I am going short versus how often I am going long, to make sure that I'm not overdoing it. So if I'm being very picky and I get a situation like this where this just to me is very much what we saw here, where you come down, you get the bounce off of the 50 EMA, it comes up for like an A, B, C. That's basically exactly what I'm seeing here, in the sense that when it got up here, we had this area, this high was established as our high confidence stop loss. If we were looking at shorting right in after this candle, like right in here, it becomes very interesting because you have this stop loss and you've got a chance to enter very close to it after this was an area where I was very interested in selling, and I didn't. I just missed it. It can be tricky, but this is very much what I'm seeing here, where it's just a small bounce that briefly takes us back above the EMAs and makes it look bullish. But if it doesn't continue, then we would expect a downtrend to happen, very soon after this action in here. So I'm watching this very closely, expecting 11,460 to hold as resistance over the next day or so. Seeing this cross is something that I'm paying very close attention to. If 11,460 doesn't hold, now it is going to be up. I'm going to have to change my analysis. But for now, as long as we are below 11,400 and about 70 right there, I am expecting a return to 9,800 area. And that is based on the way that I trade Consensio and the how used to I am seeing the first time we test the 200, then we bounce up, reject the 50, come back to test the 200. Now think about what I was just talking about with the moving averages on the stock market and the V bottom. And this is exactly what I'm seeing in my mind, in the sense that when we come down here and then we just V spike right up, right through this bearish moving average, that's just something that it just doesn't happen. Hardly. It's so rare that it's, to me, unnatural, and tells me that something else might be going on. Whereas this is extremely natural. You get support from one moving average, the longer term, you reject the medium term that has now rolled over and turned bearish, and then you get squeezed in between the two and form some sort of Wyckoff pattern or some sort of other pattern while this occurs. It could be, a triangle or whatever, but this is just exactly what I want to see and exactly what I'm expecting from here, that we're not just going to kind of V right through this area, that instead, even though we did close above and we're spending some time above, and now we've got a bullish cross, it is starting to at least look like it's ready to continue through, but that's just never what I expect. I always expect one test, a lower high, a bounce, and then a second test, and then see what happens here. So now we've got our first test, a bounce up, give me the lower high, and then give me the second test. When that works out, my trades tend to go very well. And like I've said in the past, when those V's do occur, I tend to lose money because I just never expect them and I never plan for them. And I want to continue being that way because that's what works for me. Despite how many V's I run into, I don't want to start trying to trade for them. So I'm really wanting to see a correction down to the 200 EMA from here, and that's where things will get very interesting. It's really interesting right here, but this is where I am really wanting to see it, and that is all that I have to say about it today. Do you have a chart you want to pull up, Tyler, or stick with this?
I'll pull up one real quickly here. Let me do that, and then we will end and let everybody get on with their holiday. Happy birthday to the U.S. and good job by the women's soccer team. They are in the finals, and I don't know yet the outcome of Sweden and Netherlands, so please nobody tell me. And let me pull this up. And this is just a quick chart on a longer term time frame. We talked yesterday about 10,100 and 11,100. These are the two green lines at 10,100 and 11,100. We blew through the first one, stopped at the second one, pulled back down towards the first one at 10.1, blew all the way through the second one at 11.1, closed all the way back below it, Now we're working on a week where we dropped all the way below the first one. Now came all the way back and are above the second one, but we've still got several days to go in the week. That's what I'm looking at on a longer term time frame. And the short leads into the intermediate moves into the long. And right now the short is back popping again, running into resistance. But the long term is still looking awfully good. But it is caught between these 2 points that we talked about before, which was very big resistance coming up to it, very big support coming down to it. We could cut through both of them, but then we get right back up into them over and over and over again. And it appears to me that that's what we're seeing here. And either these are going to reject price, or we will get a breakthrough above them, closes above them. And to me, that is extremely bullish. I am still leaning in the direction that Hyperwaves got me pointed, which is we are not going to be able to do that. We will get some kind of a reaction. And depending on how big that reaction is, if it comes all the way down here to 8,000, or even to this old setup trend line around 9,000 and stays down there, you heard Tone say that we've met his minimum requirement for a pullback from this point down to this point. But it's the bare minimum, and he would like to see more the way Socrates would like to see more. I would too. That doesn't mean we're going to see it. So we've got to be aware of all possibilities, and then we just invest based on those possibilities. And don't become settled in our ways that there's only one outcome, the one you want. And with that, just a couple of quick things, unless Socrates wants to point out anything on the longer term chart.
Just a question for you.
Yeah.
There's a number of important indicators that I am seeing, and I'd be curious to have you rank them in a hierarchy in an order of importance. And I will do the same. So for me right now, the most important thing on Bitcoin technical chart is the shooting star on last week's candle. So for me, that's number one. Number two is going to be the horizontal area that he has drawn there at 11,000. If we stay above there and close this week above there, that would be very significant for me. And I do not think that that's going to happen. And then the Parabolic Sar, I would rank third, but now it's very confusing not knowing whether or not it should be considered right. Broken or not. So that's something that I would consider very important. And then fourth to me would be the combo 13 and the aggressive 13. That'd be the fourth most important indicator to me. I never have found those very, I haven't been able to use those too well. So I never put too much weight on those on the sell setup. So what is your hierarchy of those indicators?
Well, I actually will throw Consensio as number one. I would normally say hyperwave if something's in a hyperwave, which this is, but as everyone knows, it's at the portion of the hyperwave that doesn't tell me anything. It's caught between the bottom at 1,000 and the top at 20,000, and it goes silent during that period, which is why I call it the most maniacal of the 7 phases of a hyperwave. All the others speak very specifically to you, and they tell you exactly what to do, and then you get in 7 and anything can happen. We've shown people our GE chart that it's been locked in a phase 7 forever, and it goes way, way up, gets very close even to the old peak, and then goes way, way down, goes very close to the old lows, then way, way up again. I've never seen anything quite like that, but it wouldn't surprise me if that's what we're looking at right here. But I'm going to override Hyperwave with the sequential, because the sequential is saying one thing. It is saying, and I don't mean to put too many things on this chart, but I'm going to anyway. I'm going to do that. I'm going to do that. I'm going to do that. And I'm going to take the price off. This is as bullish as it gets with sequential, excuse me, with the Consensio. You've got a long-term moving average that's been moving down for a long time. It's now turning up and it's accelerating. The intermediate turned up and is accelerating. The short-term turned up, and even with this correction we've recently had on a weekly basis, it hasn't even turned down yet. That is 100% bullish. If I didn't use any other indicator, I would just stay 100% invested in Bitcoin until it started giving me some kind of incremental sell signals. It has not done that yet. So that's number one for me. It would have been Hyperwave, but we're in the wrong part of the Hyperwave for it to give me any information. I agree that this is a very important candle. And the fact that it ended up right between my two green lines makes me feel good, like maybe I have some sense of what's really going on. That you could get up to 14,000 and then get sucked right back into the vortex between these two lines that quickly. And we'll see what this candle does, because maybe that's the end of it. If we move up from here, then this wasn't all that meaningful. But I agree with Socrates that that's very, very important. And believe it or not, I also think that this old trend line, which is the phase 2 trend line that was so important when we broke down, now we broke up above it, came back and tested it, and now we're moving away from it. So on any pullback, this will become very important to me, although no one else in the world really will be looking at it except as just another trend line, and I understand that. The stop and reverses are very important to me here, but because of what we just showed you on TradingView, I'm just not sure how to draw a conclusion that this thing wasn't broken, in which case we have a red dot up here above this action. Instead, we don't have that, which could be making this look a lot more bullish than it really is. And so that's kind of my thoughts on it.
Excellent. And while you're going through that, I remembered a tip that we got from a couple days ago, asking us to look at the TD sequential on the 2-week chart. And I just pulled it up, and it is quite interesting. Do you want to look at that? Can you pull up the 2-week?
Somebody could, but I couldn't. So I'm going to get out of this, and I will stop screen sharing and let you pull yours up. There you go.
All right, cool. So you're able to see that?
Very interesting.
Absolutely, especially seeing that it's only gotten one count while the weekly is on its third count. The 2-week has just now completed its first, and let's see when that will close. That opened on the 24th, so I would expect it to close on about the 8th. Is that right? Yeah, I think so. Still a few days left before this closes, but this is painting a very interesting picture, seeing this reversal candle in confluence with this perfected 9. That's very interesting. So yeah, anything?
Yeah, I would agree. Whoever brought that to our attention. Thank you very much. That's a great point. We'll see if Tone wants to throw that up on his alert system. Maybe he already has. I don't remember seeing it, but that's very interesting. Good point. Okay. I just have a couple of quick things. Number one is we've got two webinars coming up. One on Friday the 12th and one on Friday the 26th, and they'll both be from 12 o'clock to 3 o'clock. They are now posted on our website, lucidinvestmentstrategies.com. The first one is going to be all on retirement accounts. We had such a great response from about a vlog that we did for a couple of hours on that, but this is going to go in depth into you can read about it on the website, but not just why it's good to have a retirement account, but all of the advantages of having a retirement account and also the disadvantages of having it. What kind of things you can put in it, how liquid and flexible you can be within it, the ridiculous advantage of trading in a retirement account on an after-tax basis. It's stupid, and we will look at that in great detail. But the most shocking thing is how few of you have them. And luckily, an awful lot of people after our first blog went out and did it, got them. And you'll see why by looking at this webinar. So please join us on that. Right now, we only take Bitcoin, but before the webinar starts, we will again be able to take cash payments. There was a bit of a glitch with our provider, and that will be back online probably 4 or 5 days before that first webinar. It'll certainly be back on in the second one. And it's so that's very exciting to me. Even more exciting is the second one's going to be on advanced and intermediate Consensio. And it basically is for those people that already know something about Consensio, but we will spend the first 15 or 20 minutes going over just the basic rules of how it works and why it works. But then we're going to get into tremendous detail of the difference between using simple moving averages and exponential moving averages, and how many people, including Socrates, use their own moving averages different than mine. And that's great because you need to change things over time periods and over asset classes. You don't have to, but it optimizes it when you do. But more importantly, how Consensio works with other with other technical tools to fill out the picture, to either help elevate a tool that is weak in a certain area, or for Consensio itself to be more precise at a certain point in time with a certain kind of asset class by using other techniques with it. And one of the masters of that, it turns out, is Socrates. The way he overlays a number of different technical tools, but using this Consensio framework, which is the way I designed it originally and have been using it for a long time, but with a fairly limited number of tools, you compared to many new tools that have been designed and used since the 1970s and the 1980s. So both of those are coming up, and we'd love to have you join us. Socrates and I will be presenting a little bit like Abbott and Costello, maybe more like Twiddledee and Twiddledum. Together, we both have different views of things, but I love the way we interact, and so it's a lot of fun for me. And with that, I will say thank you for watching. Have a great 4th of July. We will not be on tomorrow. Markets are closed. Bitcoin is not, of course. If something big happens, of course, we will be we will jump on either singularly or both of us together in terms of the crypto world. But other than that, adios, and Socrates, thank you.
My pleasure. Thank you very much, and happy holidays to everyone. I won't be available tomorrow regardless of what's going on with Bitcoin. I am going to be taking the RV out into the woods, doing some camping with some friends. So we'll be having a lot of fun for the 4th. I hope that you guys all are as well. And with that being said, we'll be excited to hear if anybody can help us to demystify how that parabolic SAR is being calculated on TradingView. That would be a tremendous help. Without anything else being said, thank you all for tuning in, and I will plan on catching up with everybody on Friday.
Great. Bye-bye.